Okay. Today, what we're going to be doing is monetary policy. Okay? And the coming 2 weeks is going to be I hope, the most fun 2 weeks of the class. Okay? Because we're going to talk about policy properly, right? We will talk about monetary policy and we'll talk about fiscal policy. Monetary policy is what? Policy about money. That's deep and perceptive. It's central banking. Okay? So let's start from here. The central bank, what does it do? Supply money. Okay? What else? That's correct. Regulates interest rates. You understand that these two answers are the same, right? If you're how would the central bank supply money? By buying bond. Thank you, that was very helpful. By buying. I'm having a difficult morning. By buying bonds. Okay? The central bank buys bonds so that money goes out of central banks. Okay? But if the central bank is buying bonds, what happens to bond prices? Yep, yes. What, can we do this in steps? You're already far ahead of me, okay? The central bank buys bonds. What happens to bonds prices? They increase. When bond prices increase, what happens to interest rates? Why is that? I gave an example, but I know. I want to make sure that you know. Bond prices increase, interest rates decrease. Why do these things go together? Okay, so that's going to be part of what we're going to talk about today. I already told you this once last week, and I do expect you to know it. But this is something that doesn't come very naturally. So let's talk about this again. This is only one thing that the central bank does, supplying money or doing what is called monetary policy. There's a reason these institutions are called banks. Okay? They are an integral part of the banking system. A second thing central banks do is, in some sense, and this differs from country to country, okay? In different levels of involvement, central banks do bank regulation. The first question here is, why do banks need regulating? Okay. There will be funny things. That's about right. Yes, if you don't regulate banks, funny things happen. And once they happen, they aren't all that funny. Yes. While this is correct, one hopes that after so many weeks of 102, we have somewhat better terminology in discussing this issue. We should be able to move beyond funny things. What happens to banks? What is the big banking pathology? What is it that we're afraid banks will suffer from if they are not well regulated? Very good, bank runs. We said, unlike in many other businesses, banks are subject to runs. That is, even if a bank is healthy, and in fact, even if a bank is known to be healthy, it can still fail because of a coordination failure, so to speak. Right? We're all going to think that other people are going to run on the bank, and in fact, we could think that other people are going to run on the bank while they know that the bank is healthy. Right? We also know the bank is healthy. Would we also run? Would we also try to get our deposits back? If you think that, let's start from here. If half of the depositors of any bank, this is correct for Turkey too, if half of the depositors of any bank try to withdraw all of their deposits, can the bank pay all of these people? No. What happens to the bank? Bankrupt. If you think that half the depositors of any bank are going to the bank to withdraw their deposits, and you also have your deposits in the bank, would you also go? Yes. But you know that the bank is actually healthy. There is no reason for you to want to withdraw your deposits. Would you still go? Why not? Why not?
Because if it's healthy, I would just wait to withdraw my money with interest rate.
Ah. She would wait so that she would get her money with interest. Well, would the bank still be there if half of the depositors try to withdraw their money and they fail? No. The problem here is when we say a bank is healthy, we talk about its solvency, right? That is, we ask whether the bank will be able to pay back its borrowing, that is the deposits, with interest once all of the projects it financed are completed. Okay? So the question here is whether the bank made good choices in lending to people. The bank is lending your money. Is it doing a good job of screening projects, lending to good people, good projects, and not lending to frauds? We say a bank is healthy when the answer is yes. So this bank is healthy. But is the bank is healthy, the bank is solvent. Is the bank liquid? Liquidity is a different question. Liquidity is, does the bank have enough cash or cash equivalent assets to pay back its liabilities? Does the bank have enough cash?
If the half of the depositors go and withdraw their money, it wouldn't have.
It wouldn't. So for banking, the answer is always no. The banking sector, by definition, takes short-term deposits, that is, creates short-term liabilities. The banks owe you all the time, right? You could go to the bank and say, I want my money back anytime you want. Is that right? On the other hand, the bank lends in long maturities. If you borrow from the bank, you borrow at a maturity of a year, 2 years, 5 years. I'm going to assume that you never borrowed from a bank. Okay? But you do know that when people borrow, especially for investment purposes, which is what most of banking is about, right? Investment is a slow process. The bank cannot say, I'm going to lend you tonight, but I will want you to be able to pay me back tomorrow. Okay? So a healthy bank is still an illiquid bank. Thus, if half of the depositors want to withdraw their money, would you also try to withdraw your money before them?
Yes.
Yes. Ah. So we got somewhere. Good. So the problem here is we all know that the bank is healthy. We all know that this is a well-run bank. The project it funded are worthwhile projects. Nonetheless, we could run on the bank. Okay? That is essentially why bank regulation is so important. This is a terrible outcome. If your banks are run on, okay? If your banks fail, then you lose intermediation. That is, savings are no longer channeled to investment. This is one of the worst things that can happen to you because there are people who save hoping that good things will happen to them because they saved. What is the good thing that happens to savers? They receive interest. Because you saved, you get rewarded in the future. If your banking sector is no longer existing, can you be rewarded? No. Why not? Because you saved. What are you saving? Now we're talking properly money, right? You're sitting on a pile of cash. You will still be sitting on the same pile of cash tomorrow. And if you're lucky, nothing will have changed. Most of the time, there's inflation, and therefore your purchasing power has actually decreased. Okay? It's the banking sector that takes your savings, channels them to investment, so that there are actually more potatoes, which means you can get more potatoes as well. So bank regulation is important. And the question that we're facing now is, what could you do? What you want is to minimize the incidence, the probability of bank runs. You're the government now. What can you do? One thing you could do is to have reserve requirements. We talked about this briefly last week. Reserve requirements are the government's, and this is usually set by central banks. In our country too. Reserve requirements are the government's way of saying, you know, you probably wouldn't be that stupid, but just in case, I'm going to force you to be not to be stupid. You should not be lending out all of your deposits. This kind of makes sense, right? You don't want your banks to have zero cash. If a bank is lending out all of the deposits, then the first guy who comes to the bank and says, you know, I'd like to withdraw 5 liras, will cause the bank to be bankrupt. This is not a very healthy banking system. So the central bank says to the banks, you have to keep, say, 8% of your deposits, either in your institution or with me, as cash. That's a reserve requirement. Okay? This is the least you could do. Good. Could you do other things? One way to make sure that the banks are never run on is to have 100% reserve requirement. If you get deposits, you're just going to sit on them. Would that bank be run on? Will that bank be able to pay all of the depositors if all of them go to the bank? Yes, because it's keeping all of the deposits at the bank as cash. Okay? So a bank run is not an issue for a bank with 100% reserve requirement. But that bank is not doing banking, right? There is no lending going on.
What about the interest rate?
That's a very good question. If you have a 100% reserve requirement, would that bank be able to pay you interest on your deposits? No, because it wouldn't be able to lend to anyone. Okay? So this kind of makes sense, right? What we're doing by having a 100% reserve requirement is we're telling banks, you will no longer do banking. You will no longer do intermediation. You will no longer take short-term deposits and give long-term loans. If there is no banking, there are no bank runs. But if there is no banking, there is no services rendered, right? There is no investment. So there is no interest on your deposits. Okay? Could we do anything else? Let's say we have very high reserve requirements. Let's say we have, say, 25% reserve requirement. Okay? Would that be enough to make sure that bank runs will never happen? No. You immediately see that anything below 100% is still open to runs. Okay? So if you have 0, then the bank will never last. You would like to have some reserve requirement, but this alone will not stop bank runs. What else can you do? There are usually 2 more things that people often think about. And in fact, in most countries, in all serious countries, are being done. One is to say, look, one of the big problems of the banking sector is people don't quite understand what the banks are doing. This isn't in the big theoretical sense. That is, we're not worried that people don't understand banks do intermediation, blah, blah. Okay? We're worried literally that you don't know which projects are funded by your bank. You don't know whether your bank is in good shape or in bad shape. In fact, who has a bank account? What do you know about the health of your bank?
No, exactly. What kind of projects?
So the general answer here is you just don't know. Okay? He doesn't know. I don't know either. Right? I do know that banks are in general doing well. Do you have that feeling for Turkish banks as well? Why? What? Okay, that's one thing. You know, There was this crisis. Banks in many countries failed. Our banks did gloriously well. And we're going to talk about why.
It's just related with the 2001.
Fair, and we'll talk about that too. This general feeling of our banks are doing well comes from prudential regulation. This is a phrase that central bankers love, okay, and bank regulators also love. Prudential, basiretli. Ney? Basiretli. Prudential regulation is the government's way of telling you that, look, I know you people, the depositors, individually, have no way of making sure your bank is healthy or not. You neither have the time nor the expertise to go over the bank's books and ask which project is funded, which project is not funded, and go to those projects and check whether the project actually exists or not. Even if you had the time and expertise, the bank wouldn't tell you, right? Why not? Because, well, who knows? Maybe you are the guy working for the rival bank. Okay. These are banking secrets. In fact, the bank would get into serious trouble if it did tell you who its borrowers are, who its lenders are. Okay? The problem here is that you have no way of knowing whether the bank is healthy or not. In which case a bank run is more healthy? If let's say the banks are actually healthy, but we don't know this. Okay? In which case the bank run is more healthy? If we fear that the banks might not be healthy, or if we know that the banks are healthy. In which case a bank run is more likely. Okay? You immediately understand that if you already think that the banks might be insolvent, the banks might be having problems, you begin to think, well, other people will think the way I do. Other people will also feel that perhaps the banks aren't doing well. Other people will also be thinking, what do other people think? Okay? So this general feeling of, nah, the banking sector isn't doing too well is the worst thing that could happen. There is a reason why this country has very strong laws about talking about bank problems. You would never read in a newspaper an article that says, this bank is doing badly. You would get into sufficient hot water by saying, it is said some bank is doing badly. If you name the bank, you just get your ass kicked. Okay? This is written in the law. And there's a reason why. Assume that you open the newspaper in the morning and it says, Yapı Kredi is teetering at the brink of collapse. Once that news is out, is there any way of saving Yapı Kredi? Okay, that's why. Look, you didn't even ask me whether Yapı Kredi is actually teetering at the brink of collapse. It's sufficient that you think the bank is doing badly. That's why it's not allowed to write stuff about individual banks' problems, right? But that makes it all the more likely that there's going to be rumors about, some banks are said to be failing. Some banks are having difficulties. You should be able to see that this is terrible. Because now we trust no banks. What are we to do? The government says, okay, you individually do not have the time, do not have the expertise, and do not have the ability, because the banks won't tell you, to know whether banks are doing well or not. So you can't check on your bank. But I can do this. The government can do it on your behalf. So the government says, I will make sure that I go to the banks, every single day. In Turkey, you could actually do this. We have a small number of banks. This is the European system. In Europe in general, you can do this. The European system is branch banking. You have a small number of banks with many branches. So it's sufficient that you're regulating the main bank. In the US, this is more difficult because you talk about thousands of small banks. Okay? But in all countries, the idea is the same. You tell the people, I will check on your bank on your behalf. If you know that this is well done, Would this make you feel better about your banks? Okay? Who does this in Turkey? BDDK. There's one last thing. This may also fail. All that's required is for you to say, well, these guys aren't doing their job well. They aren't properly regulating the banks. They aren't properly looking at the balance sheets. Are these people doing their job well? They're doing it incredibly well, actually. Turkish bank regulation is, for my taste, too tough, but it's very, very well done. Okay? We will talk about this a little bit, I guess, next week when we talk about Turkey properly. One of the most important parts of this regulation is the following. Remember that your bank has assets and liabilities. Okay? In liabilities, you have deposits. In assets, you have cash and loans. This is not a very good bank for the following reason. This bank manager, the owner of this bank, is lending only other people's money. It's just deposits. This is where the word incentive becomes very useful. This guy's incentives are not aligned with the depositor's incentives. If the bank does well, he gets rich. If the bank fails, nothing happens to him. Would this guy take a lot of risks? Yes. Do you want your banks to take a lot of risks? No. So what is usually done is to say, to have a bank, you have to have bank capital. Bank capital, or capital in any firm, including a bank, is what the owner puts in. So it says, you cannot just fund yourself by deposits. You, as the bank owner, have to put in a significant chunk of money to start the bank. And the total size of the bank, that is, how much you can lend, is going to be tied to how much capital you have. So the world standard is your banks should have 8% capital. 8% doesn't sound a lot, but when you talk about the bank having, a balance sheet of billions and billions of liras, right, that's a lot of capital. While the world standard is 8% capital, going into the crisis, the Turkish banking system on average had about 19% capital. Okay? More than twice what is deemed sufficient by the world standards. Now, it turned out the world standards were not sufficient at all. Many banks that did have 8% capital went under. What happened to the capital? This is called the capital adequacy ratio. What happened to capital adequacy in Turkey? That 19%, what happened to it? There's no way you would know, so I'm asking you to, well, if you properly read the newspapers, you would know, but I'm assuming that you don't need the details about banking system capital in the newspaper. This thing went down to like 17%. So the answer is about nothing. This is a number that the BDDK, the Turkish bank regulator, cites all the time. Why is that? Look, this bank lent. Some of the lending went bad. It wasn't paid back. Who takes a hit? The depositor or the capital? It's the capital. Okay? This is how banking is run. The bank regulator tells the bank, look, if you screw up in lending, okay, it's your money that's going to go bad first, before other people's money. Because you've studied sufficient economics, you understand immediately why this is a very good incentive structure. Okay? If you do stupid things, you're going to lose before other people do. Very good. Have the banks done stupid things? Apparently not, because nothing happened to their capital. Okay? So these guys did very good bank regulation. On the other hand, having 20%, so I'm just rounding it up, having 20% capital is a ton of capital. If you have 20% capital, that means you put in a ton of capital and you don't lend all that much. Otherwise, this wouldn't be 20%. Okay? So the Turkish bank regulator tells the banks, you have to put in a lot of capital and I don't want you to lend a lot. Is this good? Well, it's good for the banks. Is it good for investment? Okay? So you should be able to see this. In banking, there's this constant trade-off. You want the banks to lend. You want some risky projects to be funded so that every now and then you come with a breakthrough, right? Somebody comes to you and says, you know what, I have this great idea. I'm going to make this machine that's going to move without horses. Okay? Now, do you want your banks to fund this project? Sounds like a very speculative, risky business to me. Because we've never seen in our lifetimes, right? You understand the feeling now. So there's this constant tension between you want to take some risk because there is no returns if you don't take risks. But you don't want your banks to take a lot of risks because then people fear whether the banks are healthy or not. Okay? In Turkey, we are squarely in the we don't want the banks to take risks camp. Why is that? 2001. Right? We had our banking system wiped out in 2001, so now we're really afraid. These are very worthwhile topics to think about. Now, these two things should do well, but still, you have reserve requirements, you have a lot of capital, banks are well regulated. Nonetheless, you wake up in the morning, you think that everybody is running to the bank. Would you run? Is this still in equilibrium? Yes. These makes bank runs less likely. They don't rule it out. So there's one more thing you could do. Deposit guarantee. These two always go together. Prudential regulation and deposit guarantee. Well, that's not necessarily right. If you have deposit guarantee, then regulation becomes especially important. Deposit guarantee is the following. The government tells you, look, if for some reason the bank is unable to pay you back your deposit, I will pay you back.
Isn't that has a limit? It will take some years.
Okay, let's get to that. Let's get to that. Let's first talk about the general idea, and then we'll talk about whether there's a limit, whether it takes years or not. Let's first talk about the theory of why this is supposed to be something useful. Okay? Let's say the government indeed tells you, if the banks fail, I will pay you. Okay? Now you wake up in the morning, you think that everybody else is running to the bank. Okay? But the government tells you, if the bank fails, I will pay you. Would you run to the bank? No. Is the bank run still in equilibrium? No. Let's see why not. Remember that for the bank run to be in equilibrium, it had to coordinate the expectations, right? Everybody should be saying, I think I will be running. Okay, other people will be running, other people will think that I am running and they will too, right? So this is an equilibrium. Everybody's behavior is consistent. But now you're saying, other people are running, but I won't because the government will pay me anyway. If you're not running, will other people run? You see that this equilibrium mechanism no longer works. Okay? You're going to say, look, I don't really care whether people are running or not, because I will be paid anyway. Do you have any incentive to run? No. Will the banks ever be run on? No, as long as you trust this deposit guarantee. Okay? This is a fascinating topic in Turkey, in some other countries too, because our stupid government gave a deposit guarantee on not just banks, Turkish lira liabilities, but to all bank liabilities. And we knew that they couldn't pay it back. So the banks were run on anyway. This is 2001. We'll talk about this. Do we have this in Turkey? Who does it? What is the institution that has the deposit guarantee? Tasarruf Mevduat Sigorta Fonu. That's exactly what it is. The Deposit Insurance Fund. So the way this works is the central bank says, I want you to be liquid. You're going to hold reserves. TMSF says, if things go badly, if the bank is unable to pay you, I will pay you. But if the government is going to say this, it better make sure that things don't go badly, because this is a lot of potential liabilities. So these two institutions were funded simultaneously, right? And you understand immediately why they have to work together. If these guys aren't doing their work well, aren't doing their job well, it's these guys who have to pay. Okay? So BDDK says our banks are healthy, we're monitoring them every day, we're making sure they don't do any funny business. TMSF says, and if something goes extremely, if something extremely unexpected happens, if some bank fails, you just don't have to worry about it because I will pay you back. All right? The problem here is the following. Economists have this love-hate relationship with deposit guarantees. We like them because we immediately understand, yes, there will be no bank runs. On the other hand, let's say I managed to be a shitty bank. I'm a bad bank. Okay? I somehow, avoid BDDK's regulation. I find loopholes in the law. I do stupid things. I'm extremely risky. And I tell you, I'm going to pay 50% interest on your deposits. Okay? Would you lend to me? Would you deposit in my bank? Yes, because if I pay you, you'll be rich. If I don't, these guys will. Okay? So the deposit guarantee helps bad banks more than good banks. You don't want that. Okay? This is a serious problem because once there's a deposit guarantee, all banks are equally riskless to you. Right? So somebody comes up and says, you're too young to remember this, but dolarınıza markanıza yüksek faiz. This was actually a bank advertisement. High interest rates on your dollars and on your Deutsche Marks, which no longer exists. You immediately have to ask yourself, how come this single institution is willing and able to pay higher interest than all other banks? Okay? The answer usually is, probably these guys are about to go under and they have to borrow at any cost. Okay? Would you lend to that bank? Yes, if there are deposit guarantees. That's the problem, right? You lose all of the monitoring effects, all of the disciplining effects. So, one way that regulators try to draw the line in between somewhere is to say, we're going to have deposit guarantees, but we're not going to have infinite deposit guarantees. That is, we're going to guarantee your deposits up to a limit. Okay? So say we're going to guarantee your deposits up to 50,000 liras. That says, for the vast majority of the Turkish people, whose wealth never exceeds 50,000 liras, right? You just don't have to worry about banks. You're covered. Okay? But if you have 5 million liras, if you have the large investor in the banks, if you are the large depositor, well, we want you to take the time and be careful about which bank is a good bank, which bank is a bad bank, not deposit in the bad bank, deposit in the good bank, so that the banks have an incentive to behave. Banks will lose your business if they don't invest in good projects, if they do stupid stuff. Okay? So this is kind of a good in-between. okay? But it leaves you open to the run of the large depositors, right? You understand why almost all countries, but not us, almost all countries had an increase in the deposit guarantees during this crisis. All of the countries said, wait, suddenly people are so afraid that the banks are going to fail. Even the guys who are slightly above the deposit guarantee level will want to withdraw or may want to withdraw their money. We don't want this to happen because it's going to kill the banks. What are you going to do? You have the reserve requirements, that's just not going to help. You keep on telling people the banks are healthy, okay? But this whole thing would not have started if you had regulated the banks well enough. Okay, so people no longer have all that much faith in you saying, oh, the banks are healthy, because they understand you have no clue what you're talking about. Okay, so what can you do? This is the only bet that's left. You increase the deposit guarantee. And you saw this across the board, in the US, in Europe. Okay, almost all countries increased the deposit guarantees. We said, well, no, we really do this well. And here we're showing you, 20% capital adequacy. We don't need to offer more deposit guarantees. It worked. Very good. So, before talking about monetary policy, central banks are associated with banking, the reserve requirement. You should be able to understand that these things go together. That is, what are bank reserves? They are cash. Who supplies the cash? Who supplies the money? That's the central bank. What happens when the money supply increases? Bank reserves, that is the cash, increases. Okay? One thing that the central bank does for banks is the reserve requirement. The second one, the second function that the central bank serves for the banking system is, this is a nice phrase, learn this, lender of last resort. What does it mean?
If the banks cannot pay the depositors somehow, they can go to the central bank, ask them for loans, pay the depositors, then the depositors put their money back on their accounts. So it's kind of
Yeah, you were like trailing off at the end because it wasn't making much sense. It's kind of like that, but it's not quite like that. So the idea is this. You're a good, happy, healthy bank. At the end of the day, say today, you find yourself slightly liquid. For a bank, finding itself slightly liquid means at the end of the day, you have to close your books. You have to make sure that you meet the reserve requirement. And it turns out you were expecting to receive cash today from some other bank. It didn't come. Could this happen? Sure. But what are you going to do? This is rather terrible because you're the happy, healthy bank who, right when the day is ending, finds itself illiquid. What do you do? By definition of this being the end of the day, okay, you're not able to borrow from other people. This is where you go to your lender of last resort. You go to the central bank and say, look, I'm the happy, healthy bank, but it turns out I don't have enough cash for today. Can you lend me, and I will pay you back tomorrow in the morning? Right? And the central bank says, sure, but I will charge you an exorbitant interest rate. The central bank says, I will lend to you, but I will lend you at a penalty rate. I will lend you at an interest rate higher than what you would have to pay if you borrowed from the money market. Why is that? The central bank doesn't want to do business with the banks, right? The central bank doesn't want to be a lender to the banks all the time. You want the banks to lend to each other, and in fact, not to lend when the bank is not doing well. There's a lot of information in seeing a bank is having difficulties borrowing. Okay? So what the central bank does is it says, if your only problem is illiquidity, I will lend to you. The problem that the central bank would have is, do you have any way of knowing whether a bank that comes to you to borrow is illiquid or insolvent? Okay, so if BDDK is doing its job well, that's exactly right, the bank should not be insolvent. Well, they should not be illiquid either. Okay? What the central bank does is it says, I will lend to you, but I will ask for collateral, teminat. Okay? Imagine this. You open the newspaper and it says, Refet Bank has failed, and it failed right after borrowing 2 billion liras from the central bank. And those 2 billion liras are also gone. How would that be? The central bank would probably never, just get rid of that embarrassment. Just to make sure that that doesn't happen, what they do is they say, I will lend to you. Remember that your problem is you just don't have cash. It's not that you're a worthless bank. You have valuable things. What do you have that are valuable? In general, banks tend to have government bonds. Okay? So they have cash, they have loans that have made to other people, businesses, but they also hold government bonds. Essentially, banks lend to the government too. Right? That's what a bank holding a government bond does. Are those government bonds valuable? Sure. So the central bank says, this is the essence of this transaction. I'm going to exchange cash with your bonds. You were illiquid. You need money. Here's money. But you said you aren't insolvent. That means you have valuable things. I will take your other valuable things in case you're unable to pay me tomorrow. Okay? That's what collateral does. The interest rate that the central bank charges on these is called discount rate. It's a high interest rate. Now this is going to be the question. We will see whether you actually understand this bond prices, interest rates business. It's called a discount rate, but it's not at a discount. This is an expensive interest rate. If the market interest rate is 4%, the discount rate is usually 5%, 6%. The central bank says, don't borrow from me, borrow from other institutions. If you can't borrow, then I will lend to you, but I will make this expensive for you. The question is, if this is a penalty rate, why is it called the discount rate? You can't answer this. I will see whether you understand the explanation. The bank has bonds, okay? And the central bank has money. Bonds go to the central bank, money goes to the bank, okay? The question is, at which price do these bonds go to the central bank? So the central bank essentially is buying these today from the bank, is going to sell it back tomorrow, okay? Is it going to buy these at a low price or at a high price? Think about this, then answer, okay? So somebody said high, somebody said low. Is the central bank going to say, I think that your bonds are extremely valuable, I'm going to take your collateral and give you a boatload of money in return? Or is it going to say, for any given amount of money that I'm going to give you, I'm going to ask for a lot of bonds. That is, I'm going to charge you a low price, so that you will have to give me a lot of bonds to get money from me. Will the bonds have a high price or a low price? It's going to be a low price. The bonds will be discounted. That's why it's a discount rate. Okay? So the central bank says, I'll take your bonds, that's the collateral. I'm going to take these at a low price and essentially sell them back to you at a high price so that I will be charging you interest on this money. And that interest is going to be high. That's the discount rate. Why? Because you should not have to go to the lender of last resort. You should do your business better. Okay? Excellent. So this is the this is the central bank in its role of regulator and, in fact, helper of the banking system. Okay? Now we want to talk about the central bank as regulator of the macroeconomy in general. The question that we have is, how does economic policy work? We talked about one of the tools, right? We said government spending might move around, or taxes might move around. That's fiscal policy. Okay? Fiscal policy tends to be very slow. Deciding to do spending or increase taxes or decrease taxes, these are slow things. Currently, most of economic policy is, or most of high-frequency economic policy is monetary policy. Once again, money. What determines money demand? We will want to talk about the money market, right? On the one side, there's going to be the central bank that supplies money. On the other side, there's going to be, us. We're going to be the people who are going to hold the money and use the money. So let's talk about us first. What determines our money demand? It's purchasing power. Okay, this isn't quite wrong, but it isn't very helpful. Okay? For the following reason. Let's say the purchasing power of money is low. That means the price level is high. Don't you demand money? Yes. The question here is, if there are more goods and services to be purchased, do you demand more money? Yes. Let's talk about money demand.
Isn't it also about the needs? Like, I don't need the goods and services of diamonds, so I don't need money for diamonds.
Diamonds. Okay, so those are goods I'm not very familiar with, but I don't really care whether, in fact, I don't care, and the diamond producers don't care whether you and I need or want diamonds. If we see them produced, we see them produced because somebody wants them. Okay? Remember that we're talking about an equilibrium GDP. We see transactions. Somebody has produced this and somebody has bought this. Okay? So money demand is a function of the real GDP. This should be rather easy. If there are more goods and services to be bought, we need more money to buy these. Okay? So money demand increases with economic activity in general. This is one. So this positively affects the money demand. More GDP, people want to be more liquid. People want to use more money. This was easy. As you've studied sufficient economics by now, you understand that we are in the business of trade-offs. On the one hand, you want to hold money because you want to buy goods and services, and those goods and services are summarized in the GDP. What is on the other hand? Is there an opportunity cost of holding money? What are you losing if you hold money? Interest. If you have money, if you hold money, do you get interest on that? No. Could you have lent it to someone rather than holding money? Essentially, through banks, you could have. Okay? Would you have received an interest on that? Yes. Do you want to hold more money or less money as the interest rates go up? Less money, right? Because as the interest rates increase, the opportunity cost of holding money increases. In general, holding money is a stupid thing because you're getting nothing. You saved. The fact that you're holding money means You had income. You didn't spend all of your income, right? In fact, you aren't currently spending that income. You're just carrying it on you. That's not a very smart thing to do. These are the two main determinants of money demand. Output positively affects money demand. More transactions to be done, more money people want to hold. Interest rates negatively affect the money demand. The higher the interest rates, the higher the opportunity cost of holding money, the less money you want to hold. Good. So now we can talk. Here's the interest rate. We often denote money with L, liquidity. Money demand is something like this, right? This is just what we talked about a minute ago. As the interest rates increase, you demand less money. What does money supply look like? Upward sloping means money supply increases as interest rates increase. Money supply is something like this because money supply isn't something market determined, right? The central bank chooses money supply. It says, okay, today this is how much money I'm going to allow on the market. Does that depend on the interest rate?
Yeah, it's elastic. It doesn't.
We should be able to understand this rather well. Let's go over the mechanics of how the money supply changes. Okay? There are two markets. One is the money market. That's this. The other one is the bond market. Price of bond, quantity of bond, right? There's a bond supply. Some people want to sell bonds, right? And the higher the price, the more they want to sell the bonds. And there's a bond demand. Some other people want to buy bonds. This is just any other market, okay? Let's say we haven't talked about what monetary policy does yet, but let's talk about how monetary policy is done, okay? Let's say the central bank says, I want to, this time, decrease the money supply. How does the central bank decrease the money supply? Boo. Buying bonds, selling bonds. So the bonds part is correct, but it cannot be simultaneously buying and selling bonds. So let's decide. Which way do we want money to go? Into the central bank, out of the central bank? Okay. If the money is going into the central bank, which way are the bonds going? Okay, the central bank is going to sell the bonds and take money in return. Does this make sense to you? Good. This is going to be an open market operation. The central bank is going to say, I am buying bonds. I'm going to give you, wait, what do we want to do? Did we want to increase my supply or decrease my supply? Okay, good. Okay, in that case, the central bank is selling its bonds. No, selling bonds. I'm selling you bonds, getting your money. Okay? This is how the thought process should always work. Look, if you try to memorize this, you just can't. Understand this isn't difficult at all, though. How much money is out there? Do you want to increase or decrease it? I want to decrease the amount of money out there. So you need to get the money as the central bank. You have to give something in return. What are you giving in return? Bonds. Okay? So you're selling bonds, taking money. Good. Let's say you did that. What happens here? Money supply shifts in. Why is that? Well, there is less money. That's just it. There is less money irrespective of what the interest rate is. What happens to the interest rate? The interest rate increases. Let's see the same thing in the bond market. When the central bank buys bonds, what happens to the supply of bonds available in the market? But,
We are selling.
thank you. That's better. When the central bank sells bonds, what happens to the supply of bonds available in the market? Now it's making sense. When there are more bonds in the market, what happens to the bond price? Bond price decreases. What happens to interest rates when bond prices decrease? Ah, that's just what we saw. It's nice, isn't it? Kind of, yeah. If you're anything like me, you get some satisfaction out of how this all works together. Cool. So we could think of the bond market and say, because the bond supply is increasing, the bond price is falling and the interest rate is increasing. Or we could think in the money market and say, because the money supply is decreasing, money is now more valuable. The interest rate is essentially the price of money, right? Because there is less money, it's more valuable. To buy and sell it, to lend it, people are going to charge a higher price. Very good. This is where we talk about the interest rates a bit more before talking about how the economy is affected from this central banking operation. The ideas of the nominal interest rate and the real interest rate are easier to understand than to articulate. But let's try nonetheless. What's a nominal interest rate?
The interest rate of this year.
The interest rate of this year. That wasn't particularly helpful, right?
Yes.
Try to explain to me.
Well, if you don't
Compare.
if you don't compare this year's interest rates with the others.
No.
Yeah, okay, then I don't know.
What's an interest rate?
When I put money in the bank and in like time deposit and it then gives extra money to me, it's
Okay. So this is something. When she puts money in the bank in a time deposit, and she gets paid back, say in a year's time, she's paid more, and the difference is the interest. And the ratio is the interest rate. Okay. But the general definition, what is the interest rate? What is an interest rate? Opportunity cost of money is very good. What's the interest rate in Turkey today? Ballpark. Slightly higher than that. So the government borrows at around 9% interest per year. Okay? That is, if she lent to the government for a year, she would get 8% interest. Here's the question. Is this a nominal interest rate or a real interest rate? Nominal. Why?
No inflation, unadjusted.
Unadjusted inflation, money, these are all parts of the answer. You lend to the government for a year today, you get 9% more next year. You get 9% more what? Ah, that's exactly what it isn't. Do you actually get 9% more purchasing power? That is, do you get 9% more potatoes? Or do you get 9% more money? Do you get 9% more money or potatoes? I don't even know whether the money in my pocket is this year's money or last year's money.
You can guarantee that you will have same purchasing
No, let's not get there yet. Okay, let's not get there. The government says, I'm going to sell you a bond. This bond will pay 100 liras a year from now, and you buy this for 90 liras. How much interest are you getting? Let's see. 100 minus 90. That is. Once again, if you buy the 100 lira bond for 90 liras today, how much interest are you getting? Very good, very good. 10 liras, not percent, 10 liras. Yes, I'm making your life easy. Okay? Is that a nominal interest? It's not a rate, right? It's the absolute amount of interest. Is that a nominal interest or a real interest? This asks the question, this is essentially the question, do you understand what nominal and real are? Okay. Nominal is money. Real is potatoes. Right? Are you getting 10 liras more money, or are you getting 10 more potatoes? You're getting 10 liras more money. Do you know that you will get 10 liras more worth of more potatoes? If there was no inflation, yes. So let's talk about this. The nominal interest rate is easy, okay? This is the monetary interest rate. That's just what it is. How much more money you have to pay when you borrow today. The real interest rate comes in two flavors. These are Latin, and these are very basic, dare I say, scientific vocabulary. Ex ante is before the event. Ex post is after the event. The nominal interest rate is easy to talk about and think about, because when I tell you that you're going to get 10 liras of interest, okay? Does that 10 liras change between today and the year? You get 10 liras, okay? When I say there is 15% interest, it's just 15% nominal interest. The real interest rate is different. The real interest rate depends on the inflation rate. The real interest rate is what happens to your purchasing power. What happened to the transfer of the purchasing power? The nominal interest rate is the transfer of the money, okay? I gave you 90 liras today. I'm going to take 100 liras from you a year from now. That's the nominal story, okay? Let's say, once again, we're in the potato economy and the potato costs 1 lira. I gave you essentially 90 potatoes worth of purchasing power today, right? What do I expect to get in a year's time? See, you immediately see that what I think will happen in terms of purchasing power and what actually happens might be different. That's why we have to differentiate between the ex ante real interest rate and the ex post real interest rate. Let's assume we think there's going to be no inflation, okay? With zero inflation, what is the ex ante real interest? How many more potatoes do I think I will get? 10. I'm going to get 10 liras more and 10 potatoes. I expect 10 potatoes worth of more purchasing power. That's the ex ante, that's the expected real interest. Okay? Let's say we get screwed. Inflation turns out to be 100%. The potato price doubles. A year from now, how much money do I get? The total money I get is 100. The nominal interest I get is 10. Really?
Yeah, but didn't you say the potato price has doubled?
Yes. So I have 100 liras. How many potatoes can I buy with 100 liras? 50. I used to be able to buy 90 potatoes. Now I can buy only 50. What is the real interest rate? It's a huge negative number. Okay? I thought I'd be getting 10 more potatoes. I ended up getting 40 less potatoes. I can only buy 50 potatoes now. Okay? The ex post interest rate, the ex post real interest rate, depends on the realized inflation. We don't know this when we're going into this transaction, right? I'm lending you for a year's time. This is something very important, and it's especially important for Turkey. We borrow and lend in money, okay? But, as we have established earlier, we don't eat money. What really matters is the purchasing power. The real interest rate is the transfer of the purchasing power that will happen as a result of this transaction, this lending and borrowing. What is tricky here is the following. Let's assume we think inflation will be 0. Okay? And we're happy to lend at 10% interest, nominal interest, thinking that this is going to be 10% real interest. Very good. By the way, a 10% real interest rate is a very high real interest rate. Let me ask you this following question. If inflation is not going to change at all, okay, what is the ex-ante real interest rate in Turkey today? What's the inflation rate? 10. Okay, let's make our life easy. Let's round it down to 10. It's 10% inflation. This is the realized inflation over the past year. Assume that that's not going to change over the next year. So we're going to have 10% inflation. Okay? What is the nominal interest rate? It's about 9%. What's the ex-ante real interest rate? Minus 1%. Can this happen? Well, it is happening, but how come this makes sense? Somebody tells you that, give me your purchasing power, and I will give you less purchasing power next year. And we're still doing this. Why? This might be one answer. Perhaps people think that inflation will be 5% over the next year, so that the real interest rate will be positive. Does this have to be the case? Would people still lend if they thought inflation is going to be 10%?
Yes.
Uh-huh.
Because if they took the money in their pocket, it will also.
Excellent. That's exactly the point. What she's saying is, well, you have to think about the alternative. If you lend, you get 9% nominal interest rate, and the real interest rate, the ex-ante real interest rate, the expected real interest rate is minus 1%. You expect to lose 1% of your purchasing power. If you don't lend, what happens? You get minus 10%. Would you lend? Yes. Okay. That's the other thing. Obviously, another alternative is to spend it, but even when your purchasing power is eroding, you're not going to spend all of your income. However, you can immediately see why inflation is a bad thing, right? If you think that inflation is going to be high, especially if you think that inflation is uncertain, it could be high or very high or extremely high, okay? Two things happen. One, you save less because you're going to lose more, right? People are risk averse. If inflation turns out to be much higher than they expected, they're going to lose a lot of purchasing power. This is what you're talking about, right? People just don't like to save much if inflation is uncertain. More importantly, if inflation is uncertain, what happens to the interest rate? I tell you that we are sure that inflation is going to be 4% versus, on average, we think it's going to be 4%, but it could be anything between 0 and 10%. Okay? Would you lend at the same nominal interest rate? In which case, would you want a higher nominal interest rate? This boils down to people's risk aversion. people don't like to take risks. If you worked all your life, saved, and you're lending, okay, you don't want to think that, well, on average I'll be okay, but there is a high probability that inflation is going to be very high and the ex-post real interest rate will turn out to be negative. The purchasing power of my savings will go down the drain. Do you want this to happen? By saving and lending, you're taking this risk. Do you want to be compensated for this risk? Are you going to tell people, as long as it's on average 4%, it's all the same? Or are you going to tell people, because there's the risk that it's going to be 7%, I will want a higher nominal interest rate just in case? Risk aversion says you will want to be compensated for the risk. This is something we see in most countries, especially in our own. As inflation risk increases, interest rates in Turkey increase. People begin to say, if I'm going to lend to you, I want to be better insured against inflation. Do you understand this distinction between the nominal interest rate, the real interest rate, and what the distinction between the ex-ante real interest rate and the ex-post real interest rate is? Good. Now we want to do the final touch, and we want to ask, who cares? What happens if interest rates are high, low, central bank does monetary policy, and therefore the interest rates increase? What are the consequences? What happens if interest rates increase?
It's more difficult to invest, so production decreases, which would cause inflation to increase.
You were doing just fine until you got to the inflation point. Here's the question. What do interest rates do? On the one side, they determine how much you want to save and how much you want to consume. Right? As the ex-ante real interest rate increases, you're rewarded more for saving rather than consuming. On the other hand, it also determines whether you want to invest or not. The investor, the entrepreneur, thinks in the following way. Either I have my own money, I have my own savings. I could build a factory or lend to the government at the interest rate. Okay? This is one way of thinking. The second way of thinking is, I have this great idea. I will either borrow from the bank, build the factory, materialize this idea, or not do this. If I borrow from the bank, I have to pay interest to the bank. Are these two entrepreneurs different? The guy who has his own savings and is going to do investment, and the girl who has no savings and is going to borrow from the bank. Are these two people solving different problems?
Both do the same investment, but different.
Really? So this is a very good way of asking my question. Are they facing different prices for their investment? Really?
Yeah, one of them is savings.
But they use the same amount of funds.
But
Someone
pay more.
savings and someone from the...
Okay, this is where you need to think like an economist, which you are. What is the opportunity cost of investment? If I say I'm the guy who has his savings ready, I could either invest or lend to the government. What is the opportunity cost of investment? It's the interest rate. Now let's say I'm the guy who's borrowing from the bank to do investment. What is the cost of my investment? It's still the interest rate. So these two actually are not different problems. Okay? This is a very simplified world I'm talking about, but the essence of the idea is correct. Here's the question. Let's say you have a bunch of investment projects with different returns. Okay. Project 1 has a 20% return. Project 2 has an 18% return. Project 3 has a 12% return. Project 4 has a, 8% return. And project 5 has a 2% return. Okay? I'll tell you that the interest rate is 15%. Would you do this project? How about this? How about this? It doesn't make sense to do the 12% expected return project when the interest rate is 15%. You neither want to pay 15% interest nor want to lose 15% interest if you have your own money. So you only do these two investment projects. Now let's say the central bank increases the money supply, decreases the interest rate. The interest rate falls from 15% to 10%. Are we still doing this? How about this? How about this? How about this? Very good. You're awake. So with lower interest rates, it made sense to do this project as well. What happened to investment? The interest rate is the opportunity cost of investment as well. The interest rate is the opportunity cost of investment as well. Therefore, as the interest rates increase, investment decreases. Investment is the most interest-sensitive component of the GDP. Thus, we now understand the transmission mechanism of monetary policy. When the central bank decreases money supply, okay, interest rates increase. When interest rates increase, investment decreases. Let's see here. Money supply decreased, interest rates increased, investment decreased. When investment decreases, what happens to aggregate supply? I love you. Yes, nothing happens to aggregate supply. Okay? Investment, remember, aggregate demand is consumption plus investment plus government spending plus net exports. Okay? So what happens to aggregate demand? Aggregate demand decreases. We now see how monetary policy affects the economy. Okay? It's true affecting investments more than anything else. Excellent. So this is a perfect time to stop this class. You now essentially know most of what you need to know for this class, okay? Because we already talked about fiscal policy. So on Wednesday, let's talk some Turkey. Okay, what's happening in our country, how this is actually done.